China, once seen as a rising economic powerhouse and a key challenger to the US, has quietly slipped into a significant economic downturn over the past year, largely overlooked by major media outlets. In many respects, the country is veering towards a potential depression, yet the scale and severity of this unfolding crisis in the Far East remain underreported by mainstream coverage. In just the first half of this year, over 1 million restaurants in China have closed as the economy faces its worst downturn since opening up to the world 40 years ago. With a strong central government overseeing the entire country, finding reliable economic figures is tough to come by, but one glance at this chart should paint the picture. This is the China HY Real Estate Index, which tracks the performance of high-yield bonds issued by Chinese real estate companies. The index has plunged over 82% in just 2 years, signaling not just a crash or a looming downturn, but a full-blown depression. These levels are even lower than what we saw during the 2008 recession more than 15 years ago. This cycle of turbulence affects not only China's housing market, but the entire economy. According to The Economist, it's not just residential real estate investment firms facing major issues. These problems are now spreading to China's most iconic sector, manufacturing. After the property bubble burst, China redirected the country's savings into producing cars, chemicals, machinery, and chips to avoid widespread unemployment. This has led to a massive overproduction on global markets. While such measures are possible in a state-controlled economy, they create ripples across the interconnected global economy. Currently, the number of loss-making Chinese industrial firms is at its highest point in 25 years. Essentially, China is masking its real estate troubles by pumping money into manufacturing to prevent job losses and maintain stability. However, this policy has caused an oversupply in various industries, leading to deflation and negatively impacting rival manufacturing markets. By flooding global supply chains with cheaper goods, China has driven down prices, making it difficult for higher wage markets like Europe and the United States to compete. While this will take years to unfold, we are already seeing the early effects. According to a report from the Financial Times, fears of deflation are already unfolding. Deflation, the opposite of inflation, might seem appealing with lower prices, but it's actually a sign of economic distress. As prices drop, consumers expect them to fall further and delay purchases, which then triggers a broader economic decline. Businesses struggle, jobs are lost, and deflation worsens. This creates a vicious cycle that's difficult to break, which is why governments fear deflation. As the article highlights, industrial producer prices fell 1.8% year on year, marking the steepest drop in 4 months, following a period of strong growth in early 2021. So just how bad is it? Well, we actually don't know for sure. Researchers at university think tanks and brokerage analysts have told the Financial Times they are under pressure to present economic news in a positive light to boost public confidence. This aligns with earlier reports from Reuters, which revealed that Chinese firms have been instructed not to mention risks in offshore listing documents or risk losing approval for IPOs. In a country like China, all information is tightly controlled by the powerful central authority, the CCP, which actively suppresses the true extent of the economic downturn. And this isn't just me raising these concerns. High-profile CEOs like Bill Winters of Standard Chartered have publicly addressed the same issue. Standard Chartered, a multinational bank with significant operations in the Asian markets we've discussed, has been closely monitoring the situation. In a recent interview on CNBC, Bill Winters was asked a similar question about China's economic outlook. His response was eye-opening, shedding light on the potential gravity of the situation. Winters emphasized how this could evolve into a much bigger problem if tensions were to escalate further. Take a listen to his alarming remarks. It highlights just how critical this issue might become.
We have asked a number of these banks and a number of these fund managers about concerns about a China slowdown, especially with issues really coming from the property sector. But I wanted to ask him more about what we're seeing as signs of waning consumer and business confidence, especially of the retail sales growing at very tepid paces, and also signs of higher youth unemployment, and also of people perhaps doing revenge saving, and whether or not that hints at more anemic growth patterns for China that might be hard to shake off. Here's what he told me, and whether or not Standard Chartered is worried about some of the more endemic and structural issues facing the Chinese consumer.
I think the environment is difficult today. So I think consumer confidence is relatively low, and international investor confidence is also relatively low. That said, there have been very substantial inflows into the bond market, and the currency has been having been weaker over the past couple of years, has been stronger more recently. So I think on balance, the market has found a little bit of an equilibrium. But we know that the underlying source of a lot of the confidence questions is the property market. And the property market has not yet completely bottomed out. So it's been a slow grind down. There are some signs from time to time that we're seeing an increase in activity, but at the same time, it doesn't feel like we've really found a true bottom in terms of price. Now, the benefit of the way this has happened in Chinese style is happening slowly. That means confidence gets eroded over a period of time, and that's obviously not a good thing. On the other hand, there are no real problems in the banking sector. And if we look at property market bubbles that have burst in the past in other markets, it's very frequently associated with a financial crisis. And when the real economy crisis translates into a financial market crisis, it's much, much, much worse. Usually have much more significant downdrafts in GDP. And I think the Chinese have said, we'll let the market find its equilibrium, but we're not going to do that at the expense of financial stability. So I think at one level they can claim victory so far, but it's definitely undermining confidence. And why I think we're seeing these continuous small stimulus programs, monetary and fiscal, policy driven, to make sure that we don't get into really a bad spiral that it would be difficult to recover from.
As the CEO of Standard Chartered mentioned, China's property market has been in a slow decline for over 3 years. Typically, when a housing market collapses, it happens rapidly, threatening the banking sector and the broader economy. So far, China has managed to avoid a full-blown crisis with various stimulus packages aimed at boosting manufacturing. But the big question is, how long can they keep this up? If the housing market collapses by 80%, as some of these analysts suggest, the long-term ripple effects could be enormous. It's easy to mask the damage for a while, but eventually something has to give, whether in China or elsewhere. When the world's second largest economy grinds to a halt and the government is spending heavily to keep it afloat, that approach is bound to be exposed sooner rather than later. While the situation may still appear stable on the surface, after 3 years, it's becoming clear that something isn't quite right. Cracks are beginning to show. Just as the 2008 recession became a global crisis, the recession unfolding in China right now has the potential to become a worldwide issue. With a significant portion of China's industrial output ending up in the US, even a small misstep in Western economies could ripple across the globe. As we've discussed, supply levels are already rising, and with consumer confidence in the US stagnating, even a brief drop in demand could ignite a global economic firestorm. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and leave a comment below letting me know how you feel about the Chinese market right now and how it can affect economies abroad.